Good afternoon, everyone. In the last class, we were discussing about the concept of the sectors of economy. We covered the various sectors of economy. Along with that, we also covered the term economic growth, economic development, the difference between economic growth and economic development. What are the various indicators that are there? So that we have discussed, and we started with the concept of GDP, and we covered GDP, real GDP, and nominal GDP. These are the terms we covered in the last class. So what are the different sectors of economy we have discussed? What are the different sectors of economy? What are the different sectors of economy? Primary, secondary, tertiary. Okay, then quinary sector. Primary and quinary sector. These are based on things we have classified. So difference between what? Difference between the primary and secondary sector. What is the difference you are finding? What is the difference between primary and secondary?
First one is using natural resources, second one is processed.
Yeah. Okay, so it is taking material and processing like secondary sector. Fine. In which type of sectors you see blue collar workers are working?
Culinary and
Culinary. Yes. Okay. In which you see white collar workers? Tertiary. In which red collar worker? Primary sectors. Yes. Okay. So those things we have discussed. What is the difference between organized and unorganized sector? Yeah, if they comes under the rules and regulations of the government, regulated by government act, then it is going to be called as what? Organized or formal sector. Otherwise, it is going to be called as unorganized or informal sector. Fine. What is the difference between economic growth and economic development? Economic growth and economic development. Which one?
Economic
Growth. Okay. And development.
measures standard of living.
Standard of living. Yes. Okay. Have we discussed? Okay. Growth is what? Growth is a unidimensional concept. Development is what? Multidimensional concept. Growth is okay. Quantitative in nature. Development is both qualitative and quantitative in nature. So those things okay we have discussed, and we started with GDP concept. What is GDP? So as we discussed, GDP is concerned about where the goods are being produced. It is concerned about where the goods are being produced. So we are concerned about domestic, we are concerned about goods and services. And we discussed, the term gross. Gross means what? Total. And we are not taking into account which cost? Depreciation cost. Okay, so we are not subtracting depreciation cost. So that's why total cost we are taking, and that's why it is called as a gross domestic product. So these things we have covered in the last class, and we discussed GDP is what? What is included in GDP? What is included in GDP or what is not included in GDP? So we discussed any transaction, barter system not included in case of GDP. Then secondly we discussed about black money is not included. Then we also discussed second-hand goods. Second-hand goods transactions are not included in GDP. Intermediate goods are not included. Yes, only final goods are included. Then yes, voluntary services are not included. That is there. And any other thing? Any other thing?
Foreign embassies will not be.
Yeah, foreign embassies within India will not be included, but Indian embassies outside will be included in the concept of domestic territory. And we discussed resident who are residing in India, whether they are managing ships or managing any air providing any services in aeroplanes and etc. That will be counted in India's GDP. So those factors we have discussed, what is included in GDP, what is not included in GDP. Finally, we discussed nominal GDP and a real GDP. What is the difference between nominal and real GDP?
nominal current.
Yes, nominal GDP uses current year, while the real GDP uses nothing but base year price. That is there. And we discussed current base year is what?
2022.
Yeah. The base year is 2022, 2023. This has been upgraded. So base year has now been upgraded, and we discussed it was applicable from what? Applicable from Friday onwards. So we have discussed Friday onwards. You saw the new base year is now being applicable. So that we have discussed. So the real GDP, we are measuring GDP at which price? At a constant price. And we discussed what is the difference between nominal and real GDP. Real GDP helps you okay, measures, okay, or compare GDP of, okay, 2 different years, while nominal GDP helps you
Quarter.
different quarters, okay, yes, okay, in the same year you can compare different quarters. That is what nominal GDP. So nominal and real GDP we have discussed in the last class. Finally, we started with the concept of what? Concept of, okay, yes, factor cost, market price, and we discussed basic price, okay. So these are the things, okay, we have started. So we discussed what is a factor cost that is incurred by okay, yes, cost that is incurred in the production process, okay, that is called as a factor cost. And we discussed factor cost is what? Okay, it is wages plus rent plus interest plus profit. So this is, okay, something that is, okay, your factor cost that we have discussed. Basic price, it is, we discussed, it is a price that is receivable by whom? By the producer, okay, price that is receivable by producer. And we discuss how we are calculating basic price. Basic price is equals to factor cost plus production taxes. Yes, okay, minus production subsidies, okay. So this we have discussed. And the third we have discussed is what? Market price. Market price we discussed is what? Market price is equals to, it is factor cost plus indirect taxes minus subsidies. So as we discussed here, we are taking which tax? Product tax. And we are taking which subsidies? Product subsidies, not production. So here we are taking product, okay, subsidies, and we are taking nothing but, okay, product tax. This is how we arrive at which price? Market price. And we discuss what is market price? Price that is paid by consumers. Yes, okay, price that is paid by the consumers, that is called as a market price. Price paid by the consumer, that is called as a market price, okay. So these are, okay, what? These are the three things you have to keep in mind: factor cost, market price, as well as basic price. So factor cost is what? Factor cost is, okay, your cost that is incurred by the producer. It includes your, okay, it includes your wages, interest and profit. Basic price is a price receivable by the producer. As we discussed, it will be calculated based on factor cost, production taxes and production subsidies. While market price, as we discussed, consumer is buying product, so what taxes will you provide? Product taxes and product subsidies, okay, that you have to keep in mind. Fine. So we discussed in the last class what is production taxes. What are production taxes? Like we discussed stamp duty, yes, okay, that is, okay, there. Then land revenue, then registration fee, professional tax, okay, profession tax, okay, those are, okay, what? Those are the example of what? Okay, and what are the example of production subsidies? What are the examples of production subsidies? Yes, okay, subsidies on, okay, like fertilizer, pesticides. Then subsidies given to whom? MSME. Subsidies given to whom? Corporations or, okay, yes, okay, so that is, okay, there. So those things you have to keep in mind. Now what is the product taxes and what is product subsidies? What is product taxes and product subsidies? So as we discussed, these are levies on a product, okay. So last class we discussed production taxes are what? They are independent of volume of production. How much you are producing, that does not matter. It will not increase or decrease. It will not increase or decrease with your production. That's why it is called as a production taxes and production subsidies. For example, we discussed maximum professional tax that you have to pay is how much? 2,500. And we discussed whether lawyer is serving, okay, 10 clients or lawyer is serving 100 clients. Doesn't matter. It has to pay nothing but, okay, 2,500 only. That is, okay, there. Clear? So it is independent of whom? It is independent of volume of, okay, production. But product is dependent on what? Product taxes is dependent on volume of nothing but, okay, what? Volume of production. How much you are producing, on that, okay, you have to pay tax, okay, that is, okay, there. Clear? So 10 goods you are producing, so product taxes will be on 10 goods. 100 goods you are producing, so product taxes will be on 100 goods, okay, that is, okay, there. So depending upon how much production, okay, how much things you are producing, based on that, okay, taxes will be nothing but, okay, levied. For example, we discussed, okay, one example of product taxes is what? GST. GST. So if you are buying let's say one cloth, you are paying a GST on that. 10 clothes you are paying, you will pay GST on 10 clothes. Okay, that is okay there. So okay, more the production, more nothing but okay, more nothing but okay. The tax is okay, you have to pay, that is okay there. So that is okay. Product taxes, clear. So you write down example of product and product taxes. First you write down. First you write down product taxes. The product taxes.
You have given yesterday.
No, production taxes I think are there. Okay, product taxes are there. Product taxes. These are the taxes that are dependent on. These are the taxes that are dependent on. Taxes that are dependent on. That are dependent on volume of product. Volume of product. Volume of product. These are paid on. These are paid on per unit of product. These are paid on per unit of product. Per unit of product. The example of product taxes are. The example of product taxes are excise duty, comma custom duty, comma sales tax, comma GST, sales tax, comma GST, comma service tax, etc. Next heading you write down product subsidies. Product subsidies. These subsidies are received. These subsidies are received. These subsidies are received per unit of product. These subsidies are received per unit of product. These subsidies are received per unit of product. Example of product subsidies are. Example of product subsidies are food subsidies, petroleum subsidies, comma diesel subsidies, food subsidies, petroleum subsidies, diesel subsidies, cylinder subsidies, comma interest subsidies provided to the farmers through bank, etc. Provided to the farmers through bank, etc. Fine. So these are concept of what? These are concept of GST that you have to keep in mind. Fine. So factor cost, market price, as well as nothing but okay, basic price. Remember the difference. Factor cost is what? Cost incurred by the producer. Basic price is what? Price receivable by nothing but okay, producer. And market price is what? Price, okay, that is okay, what? That is okay, paid by the consumer, that is okay there. Clear? Any doubt regarding this particular thing? Now, what you have to keep in mind is in 2015, you saw nothing but okay, what? You saw certain changes, okay, were done in measurement of GDP. Measurement of GDP. So in 2015, certain changes were done in the case of measurement of GDP. That is okay there. Clear? What changes were done? The one important thing that you see is okay. Before 2015, GDP used to be measured okay on the basis of factor cost. This has been changed now to the market price. So earlier we were measuring before 2015, okay, this was before 2015 and this is after 2015. So before we were measuring GDP on which price? We were measuring GDP on the factor cost. Now we have shifted to measuring GDP on which price? Okay, market price, okay, that is okay there. Clear? So this you have to keep in mind. Second thing that you have to keep in mind is what? As we discussed, GDP earlier used to be measured through expenditure method. expenditure method. Now post 2015 we have shifted towards which method? Product method. Okay, so we have shifted towards, okay, which method? Product method. Okay, so last class if you remember we discussed three ways to calculate the GDP, and we have discussed, okay, the product method, income method and expenditure method. So earlier, okay, GDP used to be measured through what? Expenditure method, but now we are shifting towards what? We are shifting towards something but, okay, product method. And earlier we discussed what? Earlier we discussed GDP used to be measured at factor cost. Now GDP is measured at which price? Market price. Okay, that is okay there. Clear? So these two changes were introduced from 2015 onwards in case of GDP. That's why it is, okay, what? It is not possible to compare GDP data before 2015 and after nothing but, okay, 2015, because their, okay, methodology to calculate were different, and also, okay, the price at which we were calculating is also different. Okay, that is okay there. Clear? So this is, okay, what you have to keep in mind. Comparison before 2015 and, okay, after 2015 is, okay, difficult. Okay, it is difficult. Clear? Any doubt regarding this one? And you remember 2026 onward we have now changed what? We have changed the base year, and base year has been now revised from when to when? From 2011-12 to 2022-23. This base year we have taken up. Okay, that is okay there. Clear? So now currently the base year that we are using for calculation of GDP is 2022-2023. Earlier this was the base year we were using. So these changes, okay, you have to keep in mind with regard to GDP. So how GDP is being calculated? Currently GDP is being calculated on market price. With which method we are using? With which method we are using? Product method we are using to calculate GDP. Fine. Any doubt regarding this particular thing? Now, last class we discussed who comes out with the GDP data. Who comes out with the GDP data? NSO. Okay, National Statistical Office. And we discussed, okay, what? We discussed it works under MOSPI, Ministry of Statistics and Program Implementation. Now remember, NSO was created in 2019 onwards. Okay, before that, okay, you have two bodies, CSO and NSSO. So if you see previous year question paper, okay, there was a question asked, okay, that, okay, who publishes GDP data in 2007-8. You will see a question asked who publishes GDP data. So answer would have been given as CSO. Okay, so earlier you had an organization called CSO, Central Statistical Office. It used to be called as a Central Statistical Office, and NSSO is called as a National Sample Survey Organization. Okay, both were working under the MOSPI only. Now both have been merged together and created a single office, which is called as nothing but, okay, National Statistical Office. Okay, so currently it is, okay, provided by NSO, that you have to keep in mind. Clear? So earlier you had a CSO, Central Statistical Office, and NSSO, National Sample Survey Organization. Now both these have been merged. Okay, and you see nothing but, okay, NSO is now publishing the GDP related data. So, and NSO is publishing a GDP related data on which method? Product method, and at which price? Market price. Okay, so this you have to keep in mind. Fine. Now another important thing is the concept of GDP deflator. Now what is a GDP deflator? It basically measures the price rise or inflation. In an economy. Price rise, okay, in an economy. So this is, okay, what measured by nothing but, okay, GDP deflator. So what is GDP deflator measuring? It basically measures the price rise or inflation in an economy. That thing you have to keep in mind. So GDP measures what? GDP measures all goods and services. We discuss all final goods and services are measured in what? Measured in GDP. All final goods and services that are produced in an economy is measured in GDP. Now, as we discussed, nominal GDP, what it gives you? Nominal GDP, it is measured at which price? Current year price. And we discussed, okay, real GDP is measured at which price? Base year price. So how much price has increased? How much price has increased from here to here? Okay, that can be what? That can be nothing but okay calculated, and based on that you can find nothing but okay what? You can find nothing but okay inflation that is existing in the economy, or price rise that is okay happening in the case of economy. So formula for to calculate GDP deflator is what? Formula to calculate GDP deflator is nominal GDP divided by real GDP into 100. Into 100. So this is current year price we are taking up, base year price into 100. Okay, that is okay there. This is how we are going to say that okay GDP okay or inflation is there. Fine. Any doubt? Let's say only one goods are being produced. Only one goods are being produced, and we are taking up what is being produced. A bike is being produced in an economy. Let's say bike cost was 1 lakh in okay 2020. And now in 2026 the price has increased to 1,20,000. Okay, that is okay there. So price has increased to 1,20,000. So as we discussed, what is the okay the GDP of this year? Let's say 2 bikes are produced. So what is going to be GDP? 2 lakh. Okay, 2 into 1 lakh is okay this one. What is the cost of 2 bike in 2026? 2,40,000. Okay, that is okay there. So now we are taking nominal GDP divided by nothing but okay real GDP into 100. Okay, that is okay there. So we'll see how much okay increase is happening. 40% increase is nothing but okay. So this is 2 lakh, no? 20 divided by 24. 24 into 20, 100. So this is going to come around 120%, means okay 20% increase is something that is okay happening in the price rise. Okay, that is okay there. Clear? Any doubt regarding this one? So this is how you're gonna find. So how much increase is happening? 20% increase is happening in the case of nothing but okay price. This can be calculated through what? This can be calculated through GDP deflator. Okay, so GDP deflator measures what? GDP deflator measures the okay the price rise or inflation that is okay there. How we are calculating GDP deflator? We are calculating GDP deflator through this formula, nominal GDP divided by real GDP into 100. That is okay there. Clear? Any doubt regarding this particular part? Fine. Next we are moving to okay what? We are moving to the 3 methods. That is okay product method. First we are going to take. So earlier we discussed okay which method we were using. Earlier which expenditure method we are okay using. Now we have shifted towards which method? We have shifted towards product method. So how we are calculating GDP through product method? Okay, that is okay. Clear? So as the name indicates, product. Product means what? Okay, product means what? Product means whatever things that are being made by the producer. Okay, so product method is dealing with which side? Producer side. Okay, product method is dealing with which side? Producer side. Expenditure method is dealing with which side? Consumer side. Because who is spending the money? Consumer is spending and buying the product that is okay there. So earlier we were trying to measure GDP from which side? From the consumer side we were trying to measure the GDP. Now we are shifting towards something but okay product method. So we are trying to measure the GDP from which side? From the producer side. Okay, that is okay there. Clear? Because who is producing the product? Producer is producing the product. So we are trying to measure the things from the producer side. Earlier we were okay measuring things through expenditure. Expenditure, who was doing expenditure? Consumer was doing an expenditure. So we were measuring through expenditure side, consumer side, that is okay there. So what is the reason why we shifted from product method to consumer method? Any specific reason, or just okay one day okay we decided and we thought that we'll okay shift now towards product method. Okay, so long we were calculating with expenditure method, we are now bored, so we'll shift towards new method of calculation. Any specific reason for shifting from okay expenditure method to product method? Inflation. Any other thing? Any other thing? Why we have shifted?
Because of the accuracy.
Because of the accuracy. Okay, why do you think okay the expenditure method is not accurate?
It's because product, we can count the product as through the GDP, but expenditure there's no proper way of calculating.
Okay, fine. Anyone else? Anyone else? Why do do you think okay we shifted from okay expenditure method to product method? One thing okay that we discuss is what is GDP? Okay, gross domestic product. It is measuring what? It is measuring final goods and services that are being produced in the economy. So final goods and services. Let's say okay, two bike is being produced. Two bike is being produced. We are talking about 2020 case. Two bike is being produced. Fine. What is the cost of bikes? Let's say 50,000 was nothing but okay cost of bike in 2020, that is okay there. So what will okay what is the GDP that is coming? 1 lakh, okay, that is okay there. Clear? 1 lakh, that is okay the GDP. Let's say okay we discuss consumer is buying at which price? Consumer is buying this two bike at 1 lakh, okay, that is okay there. So this is okay expenditure that consumer is doing, and that's why we are saying that this is okay what this is my GDP. Okay. So whether I am okay measuring through product method or whether I am measuring through nothing but okay expenditure method, okay, the GDP is coming same, that is okay there. Clear? So consumer is spending how much money? 1 lakh they are spending to buy okay two bike, and product method means two bikes are being produced. What is the okay cost of these two bikes? 50,000. So total GDP is going to be how much? 1 lakh, okay, that is okay there. So whether you are measuring product method or whether you are measuring okay expenditure method, it is okay normally coming same, okay, that is okay there. Clear? But problem arises when you also include taxes part. Okay, let's say I include okay taxes on 1 lakh. Okay, if I am purchasing two bike, government is levying okay let's say 5% of tax. Government is levying 5% of tax. Okay, so on 50,000 okay 5% of tax will be levied. Okay, so how much is the 5%? Or to make it simple, 10% will live. To make it simple, we'll make 10%. So 5,000, 50,000, 10% is how much? 5,000. Okay, so cost of bike becomes how much? 55,000 now. So consumer has to now pay how much? 1 lakh 10,000. This much expenditure consumer has to do. Okay, now this much expenditure consumer has to do. So what is the product cost? Product method, what is GDP coming? 1 lakh, because value of these product is how much? Okay, 1 lakh. But expenditure method, what is coming? 1 lakh 10,000, because consumer is spending this much money, because consumer also has to pay taxes on these particular product that is okay. Clear? So that's why there will always be variation between whom? There will always be variation between product method, income method or expenditure method. Some amount variation is going to be there. GDP is not going to come same, because in product method okay what will happen? We are just calculating the value of the product. But in expenditure method, we are also including taxes, which okay consumer has to pay another thing. So GDP is going to nothing but okay vary, that is okay there. Clear? So one okay thing that you have to keep in mind: product and expenditure method. Fine. Second thing that you have to keep in mind is what? Let's say the two bike is okay price. Two bike price okay. We discussed in 2020 what is our GDP coming? 1 lakh, because 50,000 was price. And two bike we are buying, how much we are spending? 1 lakh we are spending, that is okay. Clear? Second thing, okay, what will happen is okay, let's say in case of nothing but okay, what? In case of nothing but okay, the 2026. In case of 2026, okay. Now the government is saying that what? Government is saying that okay, you buy one bike, okay, you buy the okay this bike on 50,000. But you also pay me what? You also pay me nothing but okay 50,000 as a tax on this bike. I'll levy 100% tax. Okay, this is a luxury good. I am going to levy 100% tax on this one. Fine. So this is okay. What? This is nothing but okay. 2026 government is saying that bike cost is 50,000. I levy a tax of how much? 50,000. 1 lakh you have to pay. That is okay there. Clear? Any doubt regarding this one? So here we are okay. What? In 2020 we were producing two bike, and two bike value was what? Two bike value was 1 lakh. Okay, that is okay there. Let's say my production declined from 2 to 1 bike. My production declined from 2 to 1 bike in 2026. But okay, what is the cost of now 1 bike? 1 lakh. Okay, is there is any change in GDP? 1 lakh was GDP also in 2020. 1 lakh is the GDP also in what? 2026, because 50,000 bike cost plus 50,000 what? Tax okay that you are paying. So 1 lakh okay that you are okay paying over here also. But whenever there is okay what? There is a decline in production, what should happen? There should be decline in GDP, no? There should be decline in GDP, because from 2 bike now you are okay measuring, because what you are measuring GDP? GDP is final goods and services, okay, that is okay there, clear? So if there is a, okay, goods decline happening, production in good decline happening, GDP should decrease. But okay, here GDP is not decreasing. Why not decreasing? Because the government is levying equal amount of tax, okay, that is okay there. So that's why expenditure method may not give you correct pictures. GDP might be actually declining from 2 to 1, production is declining. Okay, but okay, in GDP figure it is not showing. Why it is not showing? Because the government is increasing the tax, okay, that is okay there. Clear? Any doubt regarding this particular thing? So that's what, okay, you have to keep in mind. When GDP is measured at which price? When GDP is nothing but, okay, measured at nothing but, okay, market price, okay, then okay, what will happen is, okay, what will happen is, okay, we include nothing but, okay, tax component, okay, that is okay there. We include nothing but, okay, which component? Tax component, that is okay there. And what you have to keep in mind, expenditure method do not gives you, okay, correct accuracy, because sometimes government might, okay, levy extra tax for which consumer has to pay what? Consumer has to pay nothing but, okay, extra money, that is okay there. Clear? Any doubt regarding this particular thing? So this is the reason government, okay, decided to shift towards which method? Product method. Okay, fine. So GDP is giving you perspective of whom? As we discussed earlier, expenditure method is giving you perspective of whom? Consumer side, not towards producer side. Another problem that we were facing was, let's say, okay, how do we come to know that, okay, which industry needs a benefit? If I have to decide which industry needs a benefit, how do I come to know? If I am a policy maker, okay, I have to decide, okay, that I have to support certain industries. These industries are facing problem. I have to support this particular industry. How do we decide? How do I decide that which industry I need to support? Whether automobile industries I need to support, semiconductor industry I need to support, or okay, cloth industry, textile industry, leather industry, which industry I need to support? Okay, how do I decide that? How do I decide that? So earlier, okay, since we were measuring it from consumer side, we don't used to get nothing but, okay, such figures from the producer side, and that's why we are shifting towards product method, so that we also get a figure from which side? Figure from nothing but, okay, producer side, so that we come to know which industries are in problem and which industries are not in problem, that is okay there. Which industry requires support of the government, which industry do not require the support of the government, that is okay there. That's why under the product method there is a concept of GVA. GVA, that is called as a gross value addition. Gross value addition. Okay, so now in product method we are calculating GDP through GVA. Okay, in product method we are calculating GDP through which one? We are calculating GDP through GVA method. Okay, that is okay there. GVA is what? Gross value addition. Gross means what? Total. Again, we are not taking out which cost? Depreciation cost. Okay, the gross means depreciation cost is included. We are not subtracting this cost. Okay, that is okay there. And what the term value addition means? What the term value addition means? So gross means, okay, we are not taking out depreciation cost. Depreciation cost is included in case of nothing but, okay, the gross. Okay, that is okay there. What is, okay, value addition? What is value addition? In simple term, value addition is nothing but, okay, your final minus initial. Final minus initial. Okay, that is going to be nothing but, okay, value addition. That is going to be value addition. Fine. Any doubt regarding this particular thing? For example, in simple term, let's say there is a farmer. This farmer is producing a wheat. This farmer is producing a wheat. Now wheat is going to what? Wheat is going to nothing but, okay, flour maker, who is converting this nothing but, okay, wheat into what? Wheat into flour. And this is then going to nothing but, okay, a baker, who is nothing but, okay, making a cake from this particular nothing but, okay, thing, that is okay there. Clear? Now let's say we are talking about 1 kg. 1 kg. Now farmers is buying what? Farmer is buying seeds. Farmer is buying what? Fertilizers. Farmer is buying pesticides. Farmer is, okay, what? Farmer is going for irrigation cost. Okay, all these things farmer is, okay, what? Farmer is nothing but, okay, putting up. So these are the costs for the farmers. So let's say input cost for the farmers is what? Input cost for the farmers for 1 kg is coming at 50 rupees. All these, okay, For 1 kg of wheat, input cost is coming how much? 50 rupees. On seeds, on fertilizers, on pesticides, on irrigations, he is spending around 50 rupees, that is okay there. And now the farmer decided to sell this sack at 65 rupees. So that okay, he makes a profit of how much? 15 rupees, okay, that is okay there. He makes a profit of how much rupees? 15 rupees, that is okay there. This, okay, 15 rupees is going to be called as a value addition. This 15 rupees is going to be called as what? Value addition done by the farmers, because he is buying value goods, okay, worth of 50 rupees, changing that, okay, goods into what? Wheat, and selling the wheat at which price? 65 rupees. So how much, okay, how much value addition that has been done by the farmers? 15 rupees value addition. Now 65 rupees, who is buying at 65 rupees? The flour maker is buying at 65 rupees to convert this wheat into flour, okay, that is okay there, and flour maker is okay, ready to sell at 75 rupees. So how much value addition that is done by the flour maker? 10 rupees value addition has been done by the flour maker, that is okay there. Clear? Next is okay what? The baker. Okay, now baker is buying at 75 rupees. Okay, adding all the ingredient and etc. and decided to sell cake at nothing but okay 250 rupees. So how much value addition that has been done by the baker? How much value addition that has been done by the bakers? 175 rupees. Okay, value addition is something that is done by the baker, that is okay there. So this is how you're going to find the term value addition. So value addition is nothing but okay what? Your okay output cost and whatever intermediate input cost you have, okay, that you have to subtract it, okay, that okay is going to arrive at what? That is going to decide how much value addition you are doing to a product, okay, that is okay there. Clear? Any doubt regarding this one? So if okay there is a more value addition, if there is a more value addition being done, then what will happen? If there is a more value addition being done, then what will happen? Then okay that sector, that economy, that okay industry is in good shape. If it is okay less value addition being done, then what will happen? Less value addition is being done, then what will happen? Okay, that is in bad shape, okay, that is okay. Clear? So how do we arrive at whether industry is performing good or industry is performing bad? Based on what? Based on nothing but okay value addition, that is okay there. If industries are adding more value, then what will happen? If industry are adding more value, then what will happen? That industry is performing in good manner. If they are not adding more value, then industry is performing bad manner. Let's say okay industry buys okay what? Industry buys a milk. Convert that milk into what? Curd also, sell curd also. Convert this milk into nothing but okay what? Okay, the paneer also, sell paneer also. Convert this into okay, this into okay what? This into nothing but okay some okay what? Some other drink, okay, milkshake and other, and selling it okay in that particular form also, that is okay there. So what will happen? The more value addition being done by the company, okay, that does it indicate? It indicates that the company is performing good. The less value addition the company will do, what does it indicate? Companies require support of whom? Support of the government, because some problem is there with nothing but okay these things. So now with GVA we are trying to analyze what problems okay the companies are facing, and with these data we are trying to support those particular sector which is okay what? Which is nothing but okay required a support of the government, which requires nothing but okay some of the help of the government, and that is why GVA is okay now being used to calculate nothing but okay GDP. Fine, any doubt regarding this one? So remember, GDP is okay trying to measure which side? GDP is trying to measure which side? Consumer perspective. GVA is trying to measure which one? Producer perspective. That is okay there. GDP is trying to measure which perspective? Consumer perspective. GVA trying to measure which perspective? Producer perspective. That is okay there. So this is okay basic difference you have to keep in mind with regard to GVA as well as nothing but okay GDP. Clear? So what is GVA? GVA is gross value addition. What is gross value addition? Final minus initial, whatever okay you are doing. That is okay what? That is nothing but okay value addition you are doing to a product, okay, that is okay there. Clear?
So in this final and minus initial, so in the example, final would be the cake, right? So initial would be the seeds.
No. Okay, we are saying that okay, this for farmers this is okay initial, this is for final for the farmers. This is initial for the farmer, this is final for the farmer. This is initial for whom? Flour maker, this is final for whom? Flour maker, this is initial for whom? Baker, this is final for the baker. So at each stage you are doing what is initial, what is final.
So it will be taken for the baker's final and at the end when it is, I mean if I am buying it.
No, you will try to measure overall value addition. Okay, you are trying to measure if you are buying at 250, that is a consumer perspective. Okay, that is a consumer perspective. 250 is what? Okay, the addition we are doing. Fine. So if GDP is coming, what is GDP? So 250 is going to be GDP because 250 the product being sold and you are buying at which price? 250, because in GDP we measure only which type of goods? Final goods. So final goods is okay, the cake. Okay, that is you are getting. So 250 is being sold in the form of cake. But to make this 250, how much value addition is being done at each stage?
Who measures this?
That is what through measuring GVA we are measuring, no? What is value addition is done at this stage? 15 rupees value addition. What is value addition being done at this stage? 10 rupees, okay, value addition. And what is value addition being done at which stage? 175, okay, that is okay there. So total value addition is being done how much? 200, no? Total value addition at all stage, okay, is 200. What is the initial cost, okay, we have written? 50. What is the final cost?
250.
What is the value addition?
200.
Fine. Any doubt? So at each level, how much value addition is okay there? We are measuring that, and that is going to be value addition between initial product and final product. Initial is 50, final is 250. That is okay there. Fine. So you'll know that at each level, okay, how much value addition is being done, and okay, which sector, at which stage we require the support. Okay, that also you can calculate. Whether farmers require more support, whether nothing but okay, what floor maker require more support, whether baker require more support, at which level you require a support, government can provide support at that level so that production increases, value addition increases, that is okay. Fine, any doubt regarding this particular thing? So this is okay, something that you have to keep in mind with regard to concept of what? Concept of nothing but okay, value addition, okay, that is okay there, clear? So how we are trying to measure GDP? So first we are trying to calculate what? First we are trying to calculate GVA. So under the product method, first we are trying to calculate GVA at basic price. We are trying to calculate GVA at which price? Basic price. And GVA at basic price is what? GVA at factor cost plus production taxes minus production subsidies. Production taxes minus production subsidies. Okay, so this is how we are measuring GVA at which price? Basic price. Then we are calculating GDP at which price now? Market price. GDP at market price is being calculated at GVA at basic price. GVA at basic price plus okay, how much? Plus product taxes minus product subsidies. So this is okay, how we are calculating GDP through which method? Through product method. Okay, GDP at market price is being calculated as what? GDP at market price is being calculated as GVA at basic price plus product taxes minus product subsidies. Right. So as we discussed, currently we were measuring GDP at which price? GDP at factor cost. Now we are switching towards okay, GDP at which price? Market price. Okay, so that is what we have done from 2015 onwards. Okay. Okay, so that is what we have discussed. Earlier we were measuring GDP at which cost? Factor cost, but now shifted towards which price? Market price. Earlier we were using which method? Expenditure method. Now we are shifted towards which method? Product method. Product method means what we are using? GVA we are using, and through GVA we are trying to calculate what? Through GVA we are trying to calculate okay, the GDP. So first we are calculating what? GVA at basic price. How we are calculating GVA at basic price? First we are calculating GVA at which cost? Factor cost. What is factor cost? We have discussed already rent plus wages plus interest plus profit. That okay, you are calculating how much production taxes you have paid, how much production subsidies you have received. Okay, that is okay there. That will calculate GVA at basic price. From GVA at basic price, what you are calculating? You are calculating GDP at market price. But okay, for that, what you have to add? Product taxes you have to add. What you have to subtract? Product subsidies you have to subtract. Okay, that is okay here. So this is how we are trying to calculate the GDP at which price? GDP at nothing but okay, market price. And this method is called as what? This method is called as a product method. Fine. Any doubt regarding this particular thing? So okay, a line you write down regarding product method. You write a line. The product method is also referred as value addition method. Value addition method, and it estimate the economic output. And deduct the cost of intermediate goods that are consumed in this process. Fine. Any doubt regarding this particular thing? So what you have to keep in mind is we are taking nothing but okay, final product. It is also referred as which method? Product method. Product method is also referred as which method? Value addition method. What we are taking is this final one and deducting which one? Intermediate or initial. So here, okay, what is happening in this example? What is the final one? In this example, what is the final one? Final one is 65. Intermediate is what? 50. Final one is okay, 75. Intermediate is what? 65. Final here is what? 250. Intermediate here is what? 75. Okay, so that you have to keep in mind with regard to what? Product method and okay, the concept of value addition method. Fine. Any doubt regarding this particular thing? So clear the term. Now we have already discussed what is production taxes. What is production taxes? Production taxes that we are using at the time of production. Okay, whether we are buying land, we have to pay certain taxes, or whether we are okay profession, we are okay using certain okay so that we are paying taxes. Okay, that is the production taxes. What is production subsidies? Subsidies that are received by corporate, MSME, farmers. Okay, that are going to be called as the production subsidies. That is okay there. What is product taxes? Product taxes are levied on the product and paid by the whom? Paid by the consumer. And product subsidies is okay something that is received by him, received by the consumer. So remember that these are okay what? These are paid by consumer and received by whom? And received by consumer. While production taxes and production subsidies are okay done by whom? These are paid by whom? Producers and okay received by whom? Producer. So that you keep in mind regarding differences between production taxes, production subsidies, product taxes and product subsidies. Fine, any doubt regarding this one? So this is the first method to calculate GDP, which is okay what we call as a product method. Fine, any doubt regarding this particular thing? The second method that we have is what? The second method that we have is a expenditure method. Also referred as a outlay method. It is also referred as which method? Outlay method. Okay, that is okay there. So expenditure method also referred as nothing but okay, outlay method, that is okay there. Clear? So how we are measuring GDP over here? How we are measuring GDP over here? So GDP is being measured okay here as what? C plus I plus G plus X minus M. So this is a formula we are using to measure nothing but okay GDP through expenditure method. Okay, C plus I plus G plus X minus M. This formula we are using to nothing but okay measure okay the concept of expenditure method. C stand for what? consumption, yes, okay, consumption expenditure by whom? Consumption expenditure by whom? Who is doing this expenditure? By the household, people. Okay, how much people are spending the money? That is okay there. I stand for what? Investment expenditure. Generally, who invests money? Okay, yes, okay, you saw nothing but okay, what? Private sectors. Okay, so they invest nothing but okay, money. G stand for whom? Government expenditure. G stand for whom? Government expenditure. X stand for whom? Export. M stand for whom? Import. Okay, so GDP is equals to C plus I plus G plus X minus M. Okay, that is okay there. This formula we use it for whom? This formula we use it for expenditure method. Fine. So okay, write one line regarding okay this one. The expenditure method. The expenditure method is also referred as outlay method. Is also referred as outlay method, and it calculates spending. It calculates spending by different groups. Spending by different groups that participate in the case of economy. That participate in the case of economy. Participate in the case of economies. See, you write down. First we write down C. C stand for consumption expenditure. Consumption expenditure, which include total spending of household. Which include total spending of household. Total spending of household on goods and services. Total spending of household on goods and services. Goods and services. Total spending of household on goods and services, such as food, housing, healthcare, clothing, etc. Healthcare, clothing, etc. Healthcare, clothing, etc. Healthcare, clothing, etc. It also include non-profit. It also include non-profit institution. Non-profit institution. It also include non-profit institution serving household final consumption expenditure. Serving household final consumption expenditure. Serving household final consumption expenditure. Final consumption expenditure. Fine. For example, you might get a question like this. If you get a question like this, Question is, which of the following will be counted under consumption expenditure? C part. Which of the following will be counted under the consumption expenditure? 2, 3, 4. Anyone else? 2, 3. Okay. Anyone else? So the first thing says expenditure on machinery to set up industries. Now this is okay expenditure that comes under investment. This is a okay expenditure that comes under investment. Expenditure on health by household, yes. Expenditure on nothing but okay education by household, that is okay there. NGO expenditure on health and education, that is okay there. Clear? Now what we have written, what comes under consumption expenditure? We have written okay also non-financial institutions. Okay, that is okay what? Non-financial institution, that is okay, or non-profit institution that is providing what? That is providing nothing but okay the health and education or household services, that is okay there. Clear? So NGOs is what? NGOs is a non-profit institution. No? Okay, they are not working for the profit. They are providing which type of services? Health and education services. Okay, that is okay there. Household services. So whatever NGO, because NGO will provide generally things free of cost at a lesser cost. Okay, so NGO has to spend money. Okay, for that to provide all these services, that is okay there. So that is counted under which expenditure? That is counted under the consumption expenditure, that is okay there. So this type of questions can be asked in the case of examination, that what comes under consumption expenditure, what do not comes under the consumption expenditure, that is okay there. So remember that consumption expenditure are household expenditure, but along with that not any okay what any nothing but okay non-profit institutions are doing any expenditure, that will be also counted under which expenditure? Consumption expenditure. So answer here will be what? Answer here will be 2, 3, 4. Like that questions can be formed in case of examination. Fine. Second, you write down investment. I you write down investment. Investment. It refers to the total value of investment. It refers to the total value of investment in economy, including gross fixed capital formation, including gross fixed capital formation, in bracket you write down investment in long term assets, investment in long term assets like building and machineries, long term assets like building and machineries. So what is gross fixed capital formation? What is okay question comes, what is gross fixed capital formation? Whatever the investment that you are doing for the formation for formation of nothing but capital, that is called as a gross fixed capital formation. Fine. So remember we discussed there are 4 factors of production: no? Land, labor, capital, yes, and entrepreneur. So these are the 4 nothing but factors of production that we have discussed. Now here capital can be what? Capital can be fixed capital also. It can be working capital also. And sometimes it also include your infrastructure capital also. So this is this is what we call as a term capital. So capital can be what? Capital can be fixed capital also, working capital also, and the infrastructure capital also, that is there. Clear? What is fixed capital? Like building. When you are creating a building, what will happen? It is a fixed capital. This building will allow to, let's say this building is allowing what? This building is allowing this coaching institution to run. So this how you are earning money? So this institution you are trying to earn money, okay, that is okay there. Okay, so what is happening is, okay, this building is helping you to earn income, no? If you are giving this building on a rent, you will earn income, okay, that is okay there. So this is okay, something that is going to give you what? Going to give you income, okay, in future, that is okay there. Okay, so that's why on capital we calculate what? Interest, okay, how much interest we are getting on these particular capital, that is okay there. Such type of capitals are going to be called as what? Capital. Okay, like building can be fixed, machineries can be fixed. Let's say you are buying a laptop, you are in software industry, you are buying a laptop. That laptop will help you for what? For a certain extended period of time, that is okay there. So it is going to be which type of capital? Fixed capital, that is okay there. Clear? Then there are certain capital which are referred as which capital? Working capital. What is working capital? What is working capital? So capital, okay, those capital which are going to be consumed, okay, in the process of production, that is going to be called as a working capital. Let's say I buy a petrol, then okay, that petrol is going to get consumed when I move from one area to another area. Let's say my business is transportation, delivery business. Okay, I am doing a delivery business. I am delivering goods from one place to another place. So for that I require what? I require petrol in my vehicle. Then only I can go and deliver. So working capital is which capital? Petrol. If I don't have a petrol, I can't move from one point to another point. It becomes which type of capital? Working capital, that is okay there. Clear? Any doubt regarding this particular thing? Let's say industries. If cotton textile industries are there, let's say industries establish a factory. Now factory is which part? Building is which part? Fixed capital. But you require what? You require cotton to manufacture that into what? Cloth. Cotton becomes which type of capital? Working capital, because it will get consumed in the process. You can't reuse it again, that is okay there. Fixed capital you can use it, reuse it, okay, but working capital you can't reuse it, okay, that is okay there. Once consumed, we will not be getting that, okay, so that type of capital is going to be called as a working capital, that is okay there. Clear? Third type of capital is called as what? Infrastructure capital. What is infrastructure capital? Now let's say, okay, we are saying that, okay, what? We are saying that, okay, there is a fixed capital also. There is which capital also? Working capital also. But despite this, okay, I am producing fixed capital, I am producing this particular, factories. In these factories I am making what? I am making nothing but, goods and services, okay, that is okay there. But ultimately what is happening? Ultimately what is happening? I have to sell this, no? For selling what I require?
Marketing.
For selling what I require nothing but, good road. I require nothing but, good nothing but, railways. To send goods to different parts, okay, that is okay there. I may require nothing but, I may require even nothing but, ports to import and export. So that is going to be which type of capital? Infrastructure capital, that is okay there. The more infrastructure capital the government will create, more will be the growth of industries, okay, that is okay there. The more infrastructure, okay, the capital the government will create, more will be the growth of nothing but, industries, okay, that is okay there. Clear? So that's why this type of capital can be of these three types: infrastructure capital, working capital, and fixed capital, that is okay there. So if whatever gross fixed capital formation, when we are talking about fixed capital formation, we are only talking about this capital. We are not talking either of this, not talking about either of this. So investment that is made in what? Investment that is made in case of nothing but fixed capital, that is going to be called as what? That is going to be called as a gross fixed capital formation. Okay, that is going to be called as what? Gross fixed capital formation, that is okay there. Clear? So under the I we are measuring? We are measuring nothing but gross fixed capital formation. What is gross fixed capital formation? Gross fixed capital formation is only dealing with which type of capital? Fixed capital. It does not deal with working capital. It does not deal with nothing but infrastructure capital, that is okay there. So this is something that you have to keep in mind with regard to term gross fixed capital formation. Fine. So we have written what line we have written?
In the bracket we have written investment in long-term
Assets and
building and machineries.
building machineries. Bracket close. Bracket close. Bracket close. And changes in stocks. Changes in stock. In bracket you are adding unsold goods, raw material. Unsold good raw materials, bracket close, and net acquisition of valuables, net acquisition of valuable, in bracket you write down such as gold, silver, stones, art, etc. Gold, silver, stones, art, etc. Gold, silver, stone, art, etc. Right? So what we are including? We are including gross fixed capital formation. Secondly, what we are including? Stocks. Okay, what is stocks? What is stocks? Okay, we are having
Anything which is not yet used.
yeah. Okay, unsold material which is not being used, that can also gives us income. Okay, in the long term that is okay there. Lastly, we have discussed which one. Okay, yes. Okay, so that also you have to keep in mind. These are okay. What? These are nothing but okay, important things. Let's say I have a painting. Painting is classic painting. Then if I sell this painting, what will happen? I am going to earn income, no? So that is my investment. Okay. If I buy any painting which is a classic painting, okay, if I sell it, okay, then what will happen? Okay, that is going to be nothing but okay, what my income. Let's say I buy a watch, okay, which is okay, which is a antique watch, okay, very unique watch. If I sell those watch, what will happen? Okay, I'll get income. So these are my investment that I'm doing. So this is okay, something that you have to keep in mind. You buy gold for investment, silver for investment. So those comes under what? Those comes under nothing but okay, terms investment. So C plus I. Next we write on G, government expenditure. Government expenditure. Government expenditure. This include total spending of the government. This include total spending of the government on goods and services. On goods and services for direct public consumption. Goods and services for direct public consumptions. For direct public consumption, such as spending on public schools, healthcare, defense expenditure, etc. Defense expenditure, etc. Fine. So
What
this
was the
is
first one? Spending.
spending on okay health, spending on okay the defense expenditure, that is okay there.
Such as spending on.
Public schools, healthcare, okay, defense, okay. So all those particular thing is okay. What all those particular thing is called as a expenditure method. Let's say if you get this question. Which of the following is a part of gross fixed capital formation? Hmm? 2, 3, 4. Anyone else?
1, 3, 4.
1, 3, 4. Anyone else?
1, 3,
1, 3, 4. Okay, fine. Anyone else? Investment is gold. Investment in gold is a okay the gross fixed capital formation. We discussed okay what include in investment. We discussed gross fixed capital formation, valuables, and stocks. Okay, this is what we are calling as an investment. Okay, so this comes under which one? Valuable, or this comes under gross fixed capital formation? Valuables. Okay, so what will happen? Investment in gold is not part of what? gross fixed capital formation, that is okay there. We have written what as an investment? We have written investment is consisting of gross fixed capital formation. It is consisting of valuable. It is consisting of nothing but okay what stocks, okay, that is okay there. Unsold raw material or other things, okay, that we have, that is okay there. So it becomes a part of okay what part of valuable. It is not part of whom gross fixed capital formation, that is okay there. Public expenditure on healthcare. It is a part of government expenditure. It is a part of which expenditure? Government expenditure, that is okay there. Investment in machinery, yes, okay, that is a part of gross fixed capital formation, that is okay there. Okay, it is a part of gross fixed capital formation. What about land? What is the land?
That is also.
Fixed capital. If land is a fixed capital, then why we are writing land as a separately, not as a part of capital? If land is a capital, is measured as a capital, why we are writing land separately? Okay, why we are not writing land as a part of capital then? Land is not counted in fixed capital. Okay, land is not counted in what? Fixed capital. That you okay remember it. Land is a separate category, not counted under the concept of capital, that you have to keep in mind. Clear? So that's why be clear what okay the question are being asking: land, labor, capital, enterprise. What comes under the capital? What do not comes under the capital? That is okay there. So land is not counted as a part of which capital? Fixed capital. Land is a separate category, that is okay there. Land, labor, capital. Capital is further divided into what? Fixed capital, working capital, and infrastructure capital, that is okay there. Clear? Any doubt regarding this particular thing? Anyone having any doubt? So answer for this is okay, only which one? 3. Okay, investment in whom? Machineries is okay, going to be what? Investment in machinery is going to be nothing but okay, your which capital? Fixed capital. Fine, any doubt regarding this one? Can you answer this one?
One and 4 is incorrect, or 2 and 3 is correct.
Two and four times.
2 and 4 correct. Okay, fine. So farmer plow. When farmers will buy a plow farmers can use it for what? Long period of time. He cannot. Okay, he can reuse it again and again. So it is going to be which type of capital? Fixed capital. So first is wrongly math. Second, computer is a fixed capital. Yes, okay, you can use it. Okay, for a long period. Again and again you can use it. So that is okay, correct. Third, yarn used by a weaver. Okay, is a working capital. Once yarn is finished, you can't reuse it again. That is okay there. So what you see is okay, yarn is okay, which type of capital? Working capital. Petrol is which type of capital? Working capital. So, okay, so 2 and 4 is okay, which capital? Working, okay, 2 and 4 is correct one. 2 is fixed capital, petrol is working capital. While yarn is which type of capital? Working. Farmer plow is which type of capital? Fixed capital. Okay, so answer here will be what? Only 2. Okay, so like this question has been asked, which is fixed capital, which is working capital. Okay, so be clear, if land is being given as an option and says that land is a fixed capital, what is okay going to be what? Wrong statement, because okay, land is what? Counted as a separate category. Okay, that is okay. Clear? It is not considered as a part of capital concept. Okay, that is okay. Clear? Any doubt regarding this particular thing? So this is how, okay, the terminology that you keep in mind can be asked in the case of examination, that is okay there. What is fixed capital? What is working capital? What is infrastructure capital? Okay, that you keep in mind. Clear? And remember this term, gross fixed capital formation. The more fixed capital formation in the economy, what does it indicate? The more fixed capital formation in the economy, what does it indicate?
Building.
Yes, okay, more building, more machineries means what? More production can happen, no? More factories, okay, more production can happen, that is okay there. So more gross capital formation means what? More will be the production, okay, that is okay there. Clear? Any doubt regarding this one? So put higher the gross fixed capital formation, higher will be the production, because we have land, labor, capital and okay, what? Capital and entrepreneur. So these are the factors of production. The more fixed capital formation means what? More production can happen in case of nothing but okay, economy. Fine? Any doubt regarding this particular part? The third is okay, what? The third is your income method. Income method, and it was also referred as what? Distribution method. It is also referred as which type of method? Distribution method. Okay, so this is okay, income method, also referred as which type of method? Distribution method, that you have to keep in mind. Fine. So what is okay, how we are calculating GDP through this one? So GDP here is calculated using this formula, that is wages plus rent plus interest plus profit. Okay, so W plus R plus I plus P. This is okay, what we call it as GDP. GDP through income method is measured through this particular formula. That is okay, what? That is wages, rent, interest plus profit. Right? So what is income method measuring? Income method measuring how when we are producing certain thing, certain incomes are being generated. We are counting that particular income. For example, okay, we are producing a cloth. So for production of cloth, what is required? So we are producing a cloth. For production of cloth, what is required? Land, labor, capital and entrepreneur is something that is okay, required. Fine. So what you see is okay, on the land, when we are okay producing something, let's say a cloth, on the land what income is being generated? Rent. On the labor, what is being generated? Wages. On the capital, what is being generated? Interest. On entrepreneur, what is being generated? Profit. So when we are producing anything, certain incomes are being generated. When we are measuring this particular income, then it is called as what? It is called as a income method. When we are measuring these things, it is called as which type of income? It is called as a income method. Okay, that is okay there. Clear? Any doubt regarding this particular thing? So this is okay, important thing you have to keep in mind. These are the three ways to calculate. These are the three ways to calculate the GDP. That is okay. What? That is a product method, income method, and expenditure method. Product method is also known as a value addition method. Income method is also known as okay the distribution method, and okay the expenditure method is also referred as what? Outlay method or spending method. Okay, that is okay there. Clear? Any doubt regarding this particular thing? So remember what is okay going to be counted, what is not going to be counted within nothing but okay GDP. And okay, remember how we are calculating GDP, what is real GDP, what is nominal GDP. Okay, those GDP deflator concept we have discussed, how we are calculating GDP deflator, those things we keep in mind. Fine, any doubt? Now, next important thing that you have to keep in mind is there are two terms. One is called as a potential GDP Another is called as a green GDP. So potential GDP as well as nothing but okay green GDP. This are the other two terms. What is potential GDP means? As the name indicates, potential means what? Capacity, capability. How much okay capability we have to produce goods and services. That is called as a potential GDP. So GDP measures what? GDP measures final goods and services that we are producing. That is what GDP is measuring. How much capability we have to produce final goods and services, that is going to be called as what? That is going to be called as a potential GDP. Okay, how much capability, how much capacity we have to produce goods and services, that is called as nothing but okay potential GDP. For example, let's say if electricity is available 24 hours, if electricity is 24 hours available, industry can function 24 hours. If industry are functioning 24 hours, they are producing goods worth of 500. Okay, if they are running throughout the 24 hours, they are producing goods of how much work, how much numbers, 500 numbers. But if electricity is not available for 3 hours, it is available for 22 hours or 21 hours, in an economy, then what will happen? The number of production is decreasing to how much? 400. So we have a capability to produce how much? 500, but currently we are producing only how much? 400. Why we are producing only 400? Because we don't have nothing but we don't have infrastructure that is being available. What is infrastructure? Electricity is something that is not available. So if we if we need nothing but improve our infrastructure, what will happen? GDP will nothing but improve. If we improve our infrastructure, what will happen? GDP will nothing but improve. That is there. Let's say if we have more infrastructure to export good or import good, then what will happen? If we have more infrastructure to export, then what will happen? Industry will produce more. When industry will produce more, we can sell goods more in the case of nothing but foreign market, that is there. But if we don't have much of port and etc., we don't have much of infrastructure to import export itself, then what will happen? Industry will not be producing more, that is there. So potential GDP measures what? Potential GDP measures nothing but capability. It measures your capability, it measures your capacity to how much maximum you can produce goods and services in case of economy. That is called as a potential GDP, that is there. So why we are measuring this term potential GDP? Why we are trying to measure this term potential GDP? So that we know our capacity, that how much increase we can do in our in our case of production, that is there. Clear? Next is a term called green GDP. As the name indicates, green means what? Green means what? Green means related to environment. Now we are talking about environment. Wherever the term green comes, generally related with what? Related with the environment. You have to keep in mind. Fine. Let's say I am producing any goods and services. I'm the industry, I'm producing petrol. Let's say, I'm running an industry. This industry is producing nothing but petrol, that is there. Now this petrol is being sold, and this petrol is what? Causing air pollution. With air pollution, what is happening? Petrol is we are burning petrol. With petrol causing air pollution. With air pollution, what is happening? People are falling sick. You see more climate change. Yes, greenhouse gases are being emitted. Climate change is something that is happening, that is there. So whatever goods I am producing have a negative impact on who? Environment, that is there. It is damaging the environment, that is there. Clear? Let's say there is there is nothing but mountain. On this mountain I have created a hotel, because lot of tourists are coming in this region. I have created a hotel over here, so that what will happen? Whenever the tourist comes, I can get nothing but more income from this particular hotels, that is there. Clear? I have cut the trees in the mountain area, build a hotel in this particular area, that is there. Clear? So I am producing what? I am producing services. These services will be counted because hotel is producing services. The services will be counted in case of nothing but GDP, that is there. But whether it is sustainable, tomorrow if let's say landslide happens, what will happen to my hotel? If landslide happens, what will happen to my hotel which I have created? It will also get nothing but damaged, that is there. So services which I am providing today, I may not be able to provide after a few months or few years, that is there. So that's why in green GDP what we are doing is what? In green GDP what we are doing is GDP we are taking up minus what we are doing is what? cost of nothing but okay what? Cost of depletion of environment. Whatever the okay environment I am depleting, damaging, okay, that cost if I am minusing from GDP, then I am going to arrive at which GDP? Green GDP, that is okay there. Okay, so how much damage and how much okay depletion I am causing of environment, okay, that cost, okay, that cost I am subtracting from nothing but okay what? Subtracting from GDP to arrive at our true GDP, that is green GDP, because this only GDP will be sustainable in a long term. Okay, other GDP is not sustainable in a long term because okay, I'm damaging nothing but okay environment or infrastructure, that is okay there. So what is sustainable in a long term? If I'm measuring that, that is going to be counted as what? That is going to be counted as the term green GDP, that is okay there. Fine, any doubt regarding this particular term? So you write definition of potential GDP also and green GDP also. The potential GDP is defined as potential GDP is defined as capability of economy to produce final goods and services. It refers to the level of real GDP of an economy. Can produce when all its resources are fully utilized, including land, labor, capital, technology, etc. Next you write down the green GDP. Okay, it is an index of economic growth. With the environmental consequences. Index of an economic growth with the environmental consequences of that growth, measured in conventional GDP. Hence green GDP monetizes the loss of biodiversity, and accounts for loss caused by environmental changes. Account for the loss caused by environmental changes. Just okay, write down this formula: GDP minus cost of depletion of environment. This green GDP. Write this formula. Green GDP is equals to GDP minus cost of depletion of environment. Fine. So this is all about the term GDP. Okay, so this you have to keep in mind with regard to term GDP as we discussed. Okay, how we are measuring GDP? What is nothing but difference between GDP and GVA? Okay, that is okay there that you have to keep in mind. Okay, If you want, you can also write few points regarding GDP and GVA. If you want that, okay, make two columns, one with regard to GDP, another with regard to GVA.
Cost of depreciation.
Environment. Okay. Make two columns, one with regard to GDP, another with regard to GVA. Okay. GDP and GVA. GVA measures the value addition. GVA measures the value additions. Measures the value additions in a product. While GDP measures the value of goods and services. Value of goods and services produced. Value of goods and services produced. Point number 2 you write down. GVA provides information regarding producer side. Okay. Next you write down. GDP measures economic activity from the consumer side. GDP measures economic activity from the consumer side. Third you write down. GVA reflects pure production performance. GVA reflects pure production performance. GDP you write down. It includes taxes and subsidies. GDP include taxes and subsidies, and hence can distort. GDP, okay, distort. Distort. The real figure. Lastly, you read GVA provides sector-wise information. Regarding value addition. While GDP measures the total or overall sector performance. Fine. So these are majorly difference to keep in mind with regard to GDP and GVA. Okay. One more thing, okay, that you have to keep in mind is there are two sides of economy. We calculate. One is called as a real, and another is called as a nominal. Okay, two sides of economy. Real, okay, deals with what? Real deals with nothing but, okay, the capital part. Nominal deals with the financial part. Okay, it deals with which side? Financial side. Okay. Nominal, okay, when we are dealing with, okay, there are two sides of economy, real side of economy and nominal side of economy. When nominal, okay, we are mainly talking about financial aspect. When real, we are talking about actual goods, how much actual goods you are producing, actual things, okay, services that you have. That is called as a real side of economy. Okay, clear? Any doubt regarding this one? So this is, okay, another aspect you have to keep in mind. Fine. So this is all about, okay, concept of GDP. Have a break, then we'll continue with NDP and